Hey everyone, Evan Schwecke, your Swipe Left for Success host and CEO of Delarosa Lending Group. We are a hard money lender as well as investors in multifamily, fix and flips, and commercial real estate development. Swipe Left for Success is designed to educate both real estate investors and entrepreneurs alike about what it takes to run a successful business. The hard money lending world is undergoing a dramatic transformation as a result of the uncertainty concerning the coronavirus's long-term impact on the domestic economy. Loans that were considered routine earlier in the year are now off the table. The impact of stricter hard money lending underwriting guidelines going forward will be felt immediately across the board by all borrowers. Today I'm going to talk about these new guidelines and how they will impact borrowers going forward. I then want to leave you with 4 action tips you can take in anticipation of the stricter hard money lending underwriting policies. Before we do that, however, we need to review how the hard money lending business has evolved over the past decade. In 2011, house flipping had become very popular because of the excess inventory created as a result of the mortgage debacle that led to the Great Recession of 2007 through 2009. There weren't many hard money lenders on the scene at that time, so they could command higher interest rates ranging from 12 to 16%. Borrowers didn't mind paying these rates because the profit margins on the homes they were flipping were substantially higher than they are today as a result of the excess supply of available homes. Fast forward to 2017, the supply of homes available to rehab was dwindling as the mortgage market had begun to stabilize, with banks becoming more conservative in their underwriting under the Dodd-Frank Reform and Consumer Protection Act. Additionally, institutional investors were buying foreclosed homes in bulk, rehabbing and renting them. This resulted in a squeeze on the supply of homes available for home flippers. While all this was going on, some Wall Street firms began looking for yields higher than the 3% they were getting on U.S. bonds. They saw the rehab market as a safe haven where they could get higher yields on their investments, secured with first mortgages on real estate assets. These institutions flooded the rehab market with hundreds of millions of dollars in lines of credit to hard money lending firms and were getting anywhere from 6 to 8% on their investment. With so much money to work with, hard money lending firms began loosening underwriting standards in qualifying borrowers. Borrowers with credit scores of 600 could now finance 90% of the purchase price and 100% of the cost to rehab the property. And then the world changed for everyone, including hard money lenders, with the pandemic and the resulting lockdown. So, what does this new world look like for hard money lenders? Before Corona, lending to rehabbers was seen as a safe haven. Now that we're in the midst of a pandemic, rehabbing is now viewed as a high-risk venture. Investors in hard money lenders are now concerned about the long-term negative impact a recession might have on the housing market. High unemployment and prospective home buyers electing to delay purchasing a new home would not bode well for the housing market. The institutions that had been the cash pipeline for hard money lenders are now demanding higher returns for the use of their capital. 12% has become the new norm for lines of credit versus the 6 to 8% at the beginning of 2020. Hard money lenders have begun implementing stricter underwriting standards as well. Borrowers with liquidity putting down 30% toward the purchase price in addition to increased escrow requirements at closing may become the new norm, providing hard money lenders with a more reliable safety cushion. So how do you as a borrower adapt to this changing dynamic? There are 4 things you can do beginning today to help you navigate this more conservative lending environment so that your business can thrive in the coming months and years. First, update your real estate investing resume. Highlight the positives regarding your previous real estate projects. This is a critical step for those of you who have done fewer than 3 flips. Assuming you did a good job on your previous flips, you might want to let a prospective lender know if you had excellent profit margins on your flips, if the projects came within budget, if you had a quick turnaround from purchase to sale. Homebuyer testimonials can go a long way in helping your cause as well. Second, If you think you may have difficulty meeting the more stringent liquidity requirements, you need to start putting money away today. Alternatively, you might consider working on a smaller flip if you feel that liquidity will be an issue and you don't have a source to meet a shortfall. Third, credit scores are going to be more of a deciding factor going forward. If your credit score is weak, start now in doing what you can to improve it. There are countless of resources online to guide you in that process. Visit our friends at debt.org for some great tips and advice on getting your credit score where it needs to be. And finally, reevaluate your financial requirements in accordance with the more conservative financial guidelines. Your bids should take into account those additional costs that you're going to incur going forward. The pandemic and the resulting lockdown has created an uncertain economic future for all of us. Real estate investors have to face the reality that there is less money to lend in the hard money lending space and that higher borrowing costs will prevail for the foreseeable future. That's the bad news, but remember, there's always a silver lining for everything. In this case, real estate investors will have fewer competitors bidding on properties because of the new tighter lending standards. If you look on the bright side, a deep and long recession will ultimately lead to a greater housing supply available for rehab and potentially better deals that'll yield borrowers higher profit margins. Don't despair, adapt and attack. Have you or anyone you know applied for a hard money loan since the onset of the pandemic? What has that experience been like? We would love for you to share that information with us because the more information we can share with each other, the better off we'll all be. Thanks for tuning in. Subscribe and stay tuned to our YouTube channel at Swipe Left for Success for upcoming episodes offering real estate investors and entrepreneurs practical advice and ideas to help you grow your business and achieve the success you envision. If you really like the show, please share it with your friends. Let us know about any topics you'd like us to explore in the comments section below. We are listening, and we'll see you at the top.